You sure you're ready?
Mm-hmm.
Okay, go.
P-TECH Course 4, Student Outline, Section 8, Basic Understanding of Accounting Records. Learning Objectives. Know where to look on the balance sheet and income statement for relevant data to aid in valuation of personal property. Understand footnotes to financials. State the importance and impact of consistency of financial records. Note, you will not be tested on any specifics from this section. This section introduces basic accounting records. What?
Okay.
P-TECH Course 4, Student Outline, Section 9, Depreciation Concepts. Learning Objectives. Define depreciation and its various components. Describe 5 methods of depreciation. Define book value and how it relates to ad valorem taxation. Differentiate between appraisal depreciation and accounting depreciation. This section examines depreciation in personal property valuation. It deals with value loss. What is depreciation? Depreciation is the loss in value from all causes. Obsolescence and deterioration are other terms that mean the same thing as depreciation. They are generally 3 recognized types of depreciation. Physical deterioration or depreciation results from wear and tear, decay, and structural failure. Functional obsolescence results from poor design and style from changes in technology. This is sometimes called technological obsolescence. Economic obsolescence results from economic forces such as legislative enactments and changes in supply and demand relationships. Depreciation assets are physical objects which retain size and shape but eventually wear out or become obsolete. These assets are not physically consumed. The economic usefulness is used up over time. In each period, a portion of each depreciable asset's usefulness expires. This portion is called depreciation expense. The amount of depreciation expense may be different depending on whether it is for financial reporting or tax purposes. For financial reporting, the salvage value of the asset is considered in determining the annual depreciation. For income reporting purposes, salvage value of the asset is ignored. Accounting depreciation versus appraisal depreciation. Depreciation means different things to different professions. Businesses usually track depreciation for federal income tax reporting purposes. Accounting depreciation. To an accountant, depreciation is a synthetic process of allowing the cost systematic. To an accountant, depreciation is a systematic process of allocating the cost of an asset over the period of time the owner is expected to benefit from the use of the asset. In other words, the $5,000 cost of a welder is spread over the 5-year life of the welder. Each year, the book value in the asset is reduced by $1,000, straight line method depreciation. To record the loss in value or wear and tear on the equipment, assuming the welder is worth less money after 1 year of use. Book value is generally the acquisition cost, including the associated cost to place the asset into production of the asset, less accumulated accounting depreciation. Business accounting records are the appraiser's best source for an asset's original cost and date of purchase. The book value rarely is a true reflection of the market value of the asset. Appraisal depreciation. To an appraiser, depreciation is the process of measuring the loss in value of an asset. An appraiser is trying to determine the market value of the asset. Book value, used by the accountant, may or may not reflect the actual market value. Loss in value may come from physical depreciation, wear and tear on the equipment, functional obsolescence, outdated computer due to new technology, or economic obsolescence. EPA preventing the use of naphtha-based dry cleaning equipment. There are different methods of depreciation. The straight line method reduces the value of the asset equally each year over the life of the asset. A declining balance method of depreciation allows for the largest depreciation to occur in the earliest years of use of the item. Methods of depreciating an asset. There are several acceptable methods of determining the annual depreciation of an asset. These methods fall into two categories, straight line and accelerated. Here are some of the more common methods. Straight line depreciation method. The simplest and most commonly used depreciation method is straight line depreciation. It is calculated by taking the purchase or acquisition price of an asset, subtracting the salvage value, and dividing by the total productive years the asset can be reasonably expected to benefit the company, referred to as useful life in accounting terms. Straight line depreciation calculation. Purchase price of asset minus approximate salvage value divided by estimated useful life of asset. Examples of the straight line method. Example number 1. You buy a new computer for your business costing approximately $5,000. You expect a salvage value of $200 selling parts when you dispose of it. Accounting rules allow a maximum useful life of 5 years for computers. In the past, your business has upgraded its hardware every 3 years, so you think this is a more realistic estimate of useful life. Since you are apt to dispose of the computer at that time, in the past, your business has upgraded its hardware every 3 years, so you think this is a more realistic estimate of useful life since you are apt to dispose of the computer at that time. Using that information, you would plug it into the formula $5,000 purchase price less $200 approximate salvage value divided by a 3-year estimated useful life. The answer, $1,600, is the depreciation charges your business would take annually if you were using the straight line method. Example number 2. The cost of a large truck is $50,000 with an economic life of 5 years and an expected salvage value of $10,000 at the end of 5 years. $50,000 purchase price minus $10,000 approximate salvage value divided by 5 years estimated useful life. Annual depreciation expense would be $8,000 per year.
Okay, go.
It's not that I don't understand.
Ready?
An equal portion of the asset's cost is allocated to depreciation expense in every period of the asset's estimated economic life. The formula for annual depreciation for financial reporting is cost of the asset minus the salvage value first divided by the estimated economic life. Is that better?
It's more mathematically correct.
Oh, excuse me, Mr. Mathematician. Salvage value is the estimated value of an asset at the end of its economic life. In financial reporting, most companies use the straight line method of depreciation. On tax returns, most companies use an accelerated method of depreciation rather than straight line. Accelerated depreciation methods. Sorry, that would just happened.
It's okay.
This is such stunning literature. I really keep my eyes open. The useful life of many assets does not follow a straight line, so accelerated depreciation, which puts most of the expenses of the asset in the first years, may be used. Depreciation on autos, for example, is accelerated. A way of accounting for this depreciation expense is to use one of the accelerated methods. These include the sum of the year's digits method and the declining balance method, 100%, 150%, or 200% methods. These accelerated depreciation methods are more conservative and, in most cases, accurate. They assume that an asset loses a majority of its value in the first several years of use. Sum of the years digits methods, SOYD, to calculate depreciation charges using the sum of the years digits method, take the expected life of an asset in years, count back to 1, and add the figures together. Example of sum of the years digits method: cost $1,000, estimated life 5 years, salvage value 100. Cost to depreciate is $1,000 less $100, or $900. The denominator is 1 plus 2 plus 3 plus 4 plus 5, or 15. So first year is 5 divided by 15, then multiplied by 900 equals 300. Second year, 4 divided by 15, then multiplied by 900 equals 240. Third year, 3 divided by 15, then multiplied by 900, 180. And fourth year, 2 divided by 15, then multiplied by 900 equals 120. And fifth year, 1 divided by 15 multiplied by 900 equals 60. Add all those values up together to get a total amount of depreciation of $900. The straight line example would have simply charged $180 each year, distributed evenly over the 5 years' useful life. Declining balance methods. To use it, first calculate depreciation as if using the straight line method. Then figure out the total percentage of the asset that is depreciated the first year and double it. Then each year that same percentage is multiplied by the remaining balance to be depreciated. At some point the value will be lower than the straight line charge, at which point the declining method will be scrapped and straight line used for the remainder of the asset's life. Example of the declining balance method. Cost $1,000, estimated life 5 years, straight line rate is 1 divided by 5 equals 0.2, or 20%. With the declining balance, you depreciate down to a floor amount or salvage value. First year, 0.20 times 1,000 equals $200. So 1,000 minus 200 equals 800 left to depreciate. So then the second year is 0.20 times 800, which is equal to 160. So 800 minus 160 is equal to 640 left to depreciate. So the third year, 0.20 times 640 equals 128. 640 minus 128 equals 512 left to depreciate. Fourth year, 0.20 times 512 equals $102. $512 minus $102 equals $410 left to depreciate. Fifth year, 0.20 times $410 equals $82. $410 minus 82 equals $328. And at that point, they're saying sixth year, no further depreciation. Modified accelerated cost recovery systems. Makers. Are you recording?
Yeah.
Modified accelerated cost recovery system, or makers. Makers is what the Internal Revenue Service wants businesses to use for calculating depreciation. Under this method, all assets are lumped into categories, and each category comes with a specific depreciation schedule. For example, all office furniture is considered 7-year property, while all computers are considered 5-year property. Each property class comes with its own preset annual expense percentages. The depreciation cost recovery system is for income tax purposes. This tax system is based on the declining balance method. It uses either the half-year or mid-quarter convention for personality.
Personality means something.
It must.
Remember at the beginning?
No.
I think
We consummated at the beginning.
I think we haven't consummated in a long time. I think a personality means something like, I don't know, personal property or something. I don't know. I forget. It was in the earlier chapter. I'll have to look it up.
Well, you better get busy getting figure that out. Anyways, taxpayers may expense limited amounts of new acquisitions each year. The IRS provides tables based on the class of life of property, the rate of depreciation, as straight line or declining balance, and the use of either the half-year or mid-quarter convention. The class life generally approximates the economic life of the property. There are 6 general classes of personality: 3, 5, 7, 10, 15, and 20 years. So I wonder if personality has to do with useful life. If that's the case, why wouldn't they just call it useful life?
No.
As a note, we paused and looked up personalty, which is personal estate or property. And it is pronounced personalty, not personality. So we look dumb, but now we look smart. So once a method is started, it must be continued. G. Some alternative methods of calculating depreciation. Number 1, units of output or service hours method. A. In the units of production method of depreciation, depreciation is charged according to the actual usage of the asset. In the units of production method, higher depreciation is charged when there is higher activity and less is charged when there is a low level of operation. Zero depreciation is charged when the asset is idle for the whole period. This method is similar to straight line method, except that the life of the asset is estimated in terms of the number of operations or the number of machine hours. Such a method is useful where a company has many fixed assets with varying usage. B. Formula. The annual depreciation expense is determined by cost minus salvage value divided by expected units of use. You do that first, and then you multiply that by annual use. Examples of the units of output or service hours method. A machine is purchased for $1,000. It is expected to provide 100,000 hours of service before wearing out. The salvage value is believed to be $100. The following example estimates its use over the next 4 years. The cost, $1,000. Estimated life, 100,000 units of production. Salvage value, $100. Subtract 100 from $1,000 first. Then divide by 100,000, which is equal to 0.009 or 9/10 cents per unit. The first year, 25,000 units times 0.009 is equal to $225. The second year, 17,500 units times 0.009 equals $157.50 per unit, or not per unit, just $157.50. Third year, 30,000 units times 0.009 equals $270. Fourth year, 27,500 units times 0.009 equals $247.50. Therefore, total depreciation is $900. there's a check mark type of note that says based on the actual use of the asset rather than a fixed rate per year.
I don't know where that's associated with.
Well, I was going back to look and I don't see it either.
Yeah.
There's a note somewhere and all that.
Continue on.
Number 2, age, life method, and percent good. The age-life method of depreciation determines the effective age of an asset for the purposes of calculating depreciation. The effective age differs from the actual age because it is based on the amount of wear and tear that the asset has sustained during its life. Excessive wear and tear in comparison to the actual age means that the asset is assigned an effective age that is greater than its actual age. Example of the age divided by life method. Age over life method.
No, age divided by life. That's
okay.
Exactly right. I can't believe you don't remember this from the depreciation that you hated so much from
I just read the words. I didn't retain any of it. Total economic life, 20 years. Actual age chronologically is 8 years. Effective age is 4 years. And replacement cost new is $1,000. Effective age divided by total economic life. 4 divided by 20 equals 0.20 or 20%. $1,000 times 0.20 is equal to $200. So total depreciation is $200. In the above example, the amount of depreciation is 20%. The depreciated value is $800. That requires subtracting the depreciation from the cost new. We could also describe the property as being 80% good. Many schedules that are created to apply a depreciation factor are actually percent good schedules. Use of this kind of schedule allows appraisers to skip this step of calculating a depreciation amount and then subtracting it. It is the percentage of a property's value that remains after accounting for depreciation. It is a function of dividing the remaining life by the total economic life. The percent good is 100% less the percent of depreciation. Sources of information on property economic life and value. The Appraisal District's Appraisal Roll. Publications such as Marshall Valuation Service, IRS publications and tables, trade association publications, market price guides such as NADA, Black Book of Valuation, Truck Blue Book, Green Guides, etc.
We use those. Some of those.
Indexing or trending values. When attempting to place a value on a particular piece of personal property, the only cost information available is old and most likely out of date. When there are no other good options, attempting to estimate the effect of inflation on cost may be an option. To make this estimate, one has to ascertain that this rate of inflation on specific industries over the number of years from when the item was new and the date of the appraisal. Index or trend factor information can be found in various publications or cost guides. By employing these taxes, the appraiser attempts to develop a replacement.
By employing what?
These indices. Indexes works too.
But you said by employing these taxes.
Oh, I did?
Yeah.
Oh. By employing these indexes, the appraiser attempts to develop a replacement cost new for the equipment in order to depreciate it by the indicated amount. In summary, here is how it works. Find the index factor for the year of acquisition and the factor for the date of the appraisal. Okay. Then the index number for the present year is divided by the index number for the year of acquisition. Index factors are applied to the historical cost of tangible personal property to estimate the current year's RCN. Then the depreciation factor that was determined by the appraiser is applied to the RCN to give an indication of the appraised market value. Example of trending or indexing. Acquisition cost, $10,000. Index for the current year, $800, I guess. No, it's just 800, not a dollar sign. So, index for the current year is 800.
Oh yeah, it's just a number.
Index for the year acquired, 600. Current year index divided by acquisition year index, 800 divided by 600 equals 1.3333. Replacement cost new is equal to $10,000 times 1.3333. Replacement cost new then is equal to $13,333. Note, trending will not take into consideration any unusual obsolescence caused by technology changes. Computers and electronics are good examples of when this might be significant. A final word on depreciation schedules. In a mass appraisal system, a methodology to apply depreciation in a uniform way to large groups of property is a necessity. Calculating individual depreciation amounts on each piece of personal property is simply not practical. As a result, appraisal districts employ national cost guides and other sources to develop depreciation schedules to apply to groupings of property, as F&E and computers, etc. Okay, that was weird. And my computer was on. Many times these schedules are created as percent good tables which allow for easier application to cost numbers. For instance, 40% of good instead of 60% depreciated. This mass appraisal percent good depreciation schedule is used to ensure that estimated values are uniform and consistent within the market. These percent good factors are applied as follows. RCN times percent good factor equals market value estimate. Take a look at the percent good schedule on Appendix A on page 171 in your free time. I ain't going to look at it right now. In summary, depreciation is a very important component in the valuation process. In the sales comparison and income approach, the assumption is made that the buyers and sellers and lessors and lessees have acknowledged whatever amount of depreciation is present and have calculated that in sales or lease rates. In the cost approach, the appraiser has to use a combination of facts and judgments to determine and apply the appropriate amount of depreciation. Typically, in a mass appraisal system, a depreciation schedule is built from the combined base of available data and then applied in a uniform manner. Depreciation schedules should be developed in-house with adjustments for local market factors.